All right, I'm here, Jesse Tinsley, the founder and CEO of Mainstreet. Jesse, how you doing today?
I'm doing good, Andrew. Thanks for having me. Glad to be here.
Yeah, thanks for coming on the podcast. I've been following you from a distance. I've heard a lot about your acquisitions, but for those that may not know you, do you want to just give a brief introduction of yourself?
Yeah. So the quick version is I grew up in the Bay Area. I went to school with a bunch of tech founders, kids. So I got into tech pretty young, one of which was Steve Wozniak. So I had all the latest Apple products growing up from like 10 onward, which was definitely helpful later on in my career. But yeah, went to school, went to college, dropped out, started a consulting company doing recruiting, and helped scale a bunch of different companies like Coinbase, Scale AI, and others, and just kind of saw that playbook for talent density, and started another company, which kind of became the genesis for Mainstreet, Lawyer.com, Career.com, everything you see today. So live in Sacramento these days, and that's me. In 60 seconds, the short version.
Right on. So, how do you think about entrepreneurship? I know you run employer.com. You, I believe, acquired Main Street and a few others. Are you a fan of just build from scratch? Are you a fan of buy and roll things up together? What's your view on what you're currently doing? And tell me more about that.
Yeah. So I think that the biggest thing for entrepreneurship is like, what's the strategic like inflection point you're at in your market, right? And like identifying the macro trends that are happening. I think that's kind of how I look at it. So right now, I think is a great time to buy businesses because I think that generally SaaS is undervalued in the marketplace, basically because of AI. SaaS multiples have swung too far to one side, and so there's a bit of a pricing inefficiency there. But I think the best thing to do is to be, long term is to be able to produce your own products and go to market. But I think right now, the thing I've been talking about a lot on social media is distribution. So the biggest thing for startups, when you can have, I can go on Replit and basically go and code, no code, byte code a solution in literally hours, and get an MVP going. And I think that with that, the biggest thing when you have thousands of new startups every like week or month is distribution. How do you get customers? How do you keep customers? I think that is where we've been focusing a lot of time and effort to get scale. So I think that's a moat.
Nice. Completely agree. Tell me about your businesses. What do they do? What problem do they solve? How do they all piece together?
Yeah. So originally, we acquired a few companies. We rebranded everything under Mainstreet. But the simple way to think of us is like G Suite for business back office. Mainstreet basically automates for SMBs like accounting, tax filing, bookkeeping, workforce management, and payroll, and like SMB banking. So it's like the simple way of like a better comparison might be even rippling for small businesses focused on the accounting and finance side, which the payroll HR side.
Nice. How did that acquisition go down? Because you acquired Main Street, and then you also acquired, I'm forgetting a name. I think it was maybe Bench. It was Bench.
Yeah, Bench was the big acquisition beginning of the year with they shut down abruptly on a Friday night.
I remember that. Yeah. And you came to the rescue. Tell me about those.
Yeah. So Bench was a really unique situation. I was actually on vacation. Again, it was just after Christmas. I was in Florida, and I actually missed the news of like Friday night. I think the original founder and CEO posted something about on Twitter that went viral, and then Bench had abruptly shut down. And I didn't hear about it till Saturday morning. And I think it's probably the quickest acquisition maybe in history. It was pretty quick. It was basically we had a term sheet out by the end of the letter of intent by the end of the day, and went and had the servers up and running by like Monday morning at like 4 or 5 a.m. Eastern. So it was pretty crazy. And I mean, that's a business that had 0 employees, 0 customers technically at the time, because it had shut down. Basically everything was at 0. So it was quite the sprint.
Walk me through how you made that happen? Because I remember when the shutdown announcement came out, a lot of customers came out upset. The co-founder had the viral tweet go out. Did you just reach out to one of the founders? Did someone approach you?
Yeah, I had a acquaintance that I was connected with on LinkedIn. It was on the C-suite. So I reached out to them and asked to be connected to the board, and they connected me to some of the board members, like a few different board directors, and anyways, picked up the conversation there. So it was a whirlwind. I didn't sleep much that weekend, nor did our team, but it was a quick turnaround, and it was kind of on our radar. Like, took a step back. Like, this wasn't some random acquisition. We had bought a ERP component, like enterprise resource like plan like component, and we were looking for an accounting like general ledger solution that we were going to API into, or like either partner with or build our own solution. And so when this came about, it was very opportunistic because I had just talked to my co-founder and CTO Ben week prior about this exact type of like thing we need to build in Q1. So it was just very fortuitous timing for all intents and purposes.
Nice. How do you value a business like that? Because they were technically shut down, and then I assume you acquired the assets and the customers, but the customers also technically were, I assume, canceled because they made that announcement they were ceasing to operate. Like, how'd you value that?
It was definitely more difficult than most, with like a lot less information, very condensed diligence time window. So in that case, like all things, it comes down to price, right? So like, they got a really good price, I think, on the business overall to make up for the fact that things were not in the best of shape. And I mean, by the way, and also further going to go into further decline come Monday or Tuesday of the following week, right? Because now you have like a melting ice cube effect where you have the ice cube in the hot sun, all your customers are just churning out, right?
Mm.
And all the competitors will be reaching out over the weekend and Monday, right? So that's point being is you would get a very good price. I think some of the reports, I want to say by Axios and others, had reported, I think 9 million or something like that cash, something like that. Like that's what was reported. So I can't confirm the exact price, but some number that was a lot lower than overall, I think, like enterprise value from my perspective.
Nice. It seems to have been a good acquisition too, because the service is now up and running. All the customers are happy.
Yeah, totally. And we're running, right. I think it's important to note to like anyone that's using like Bench, now rebranded as Mainstreet, like we're profitable, we're bootstrapped. There's no interruptions of service that can happen moving forward. We've turned that from a business that was focused on, and this isn't a knock on Bench, just to be clear. I think this is like some of the 21, 22, 23 like companies that grow at all costs, and they had really good growth, and they're one of the leaders, and that was awesome. What we're really good at is operational efficiency and everything else. So, you went from a business that was burning a lot of money in 2024 to like now, on a EBIT adjusted basis, low 8 figures and EBIT in 2025. So that's a quite the swing from operating at a loss for focusing on growth versus focusing on, efficiency of dollars essentially. And
What about the Mainstreet acquisition? Was it in a similar spot where they needed a buyer? I know they had raised a lot of venture capital. I assume maybe they were underwater on that capital and they were looking to sell, or was it different?
I don't know what their like I don't look at waterfalls so much. I think they can't speak to like what their valuation. I don't actually know like what the previous valuations were. I think there's some TechCrunch articles that talk about that. But what I would say is that more importantly, we've become like a very good like steward of businesses that are like really great. I think Mainstreet, the R&D tax credit solution, is a fantastic product, right? Like it's a business that scaled to 8 figures in revenue and was profitable and doing really well. But the tough part right now is, again, when you go back to like that distribution channel, is like, do you have a path to be like a venture scalable company, be a $10 billion company, or are you kind of stuck in this couple $100 million valuation range and like you have like steady growth, but it's not like parabolic, right? Which is where VC dollars go long term. So we got introduced by one of their investors to Mainstreet. And again, this is because we've had a good track record working for other funds like Greylock and Excel and others that brought us, businesses they've rolled equity into. And same thing I think applies for Mainstreet, without getting specifics of the deal. But they have a fantastic business. It's a very nice component to what we offer now across all things accounting, bookkeeping, tax filing, and tax consulting, as well as like R&D tax credits, which if you're a tech business and you're not using it, it's just free money. Like R&D tax credits from Mainstreet are, we don't charge you unless you save money on like taxes for R&D tax credit filing. So definitely worth checking out if you're not using it and you run a technology business.
Love it. Where are you going with all this? Are you trying to take these companies public? Are you keeping them private? Are you focusing mainly on profitability?
We're focused on growth. Contrary to like, we obviously like to operate in the black, is how I call it. But, I think focus on growth but like sustainable growth, right? So instead of like burning money, we'll spend exactly every dollar we earn towards growth. And long term, we want to be the number one accounting software platform, for SMB and eventually mid market and enterprise customers in the world. So I think like, we want to be like the modern day, QuickBooks essentially, but with a full platform for SMBs, which I don't think exists currently in the everyone's using lots of point solutions, right? So you use like Carta and QuickBooks and like Gusto, right? Like, but you should have a platform that has all of those together. Not that we're competing with Gusto on the payroll space, but more so like finance and cap table management and accounting, all of that. So
yeah. What other acquisitions are you looking at? You don't have to give specifics, but I assume your strategy is to buy other companies and continue growing your portfolio of products, or do you plan to build other products?
Yeah, it's really just a market like timing thing. I think right now we look at like the pace paradox of like how long does it take us to like build and then like go to market with said products to get the same revenue versus just buying today and arbitraging that delta in time, save that time. But we'll continue to build around like everything that gives you full data insights across the financial stack, from like contracts to invoicing to bill pay to SMB banking, which we just rolled out, and lending eventually, and other things and everything in between. So basically, you had a full like financial stack for SMBs in one platform.
That's awesome.
Yeah.
You were talking to another entrepreneur that was thinking of buying instead of building. What's like some tips you would give them in terms of maybe red flags to look out for, ways to think about it?
Yeah. So if I was buying, like giving advice, I think the tough part is like I've given other deals that didn't fit our thesis or like what we're doing to other entrepreneurs, and oftentimes they'll overpay like on legal, and like you basically need to have like a fixed cost, right? Because the deal is only as good as the value that you're spending to like get it, right? So if you're spending $500,000 on legal fees and we spend on average 75K, that's a huge significant difference that we're like, so you need to look at all your input costs, not just what you're paying for the business, but how much is your legal, how much is your accounting, and everything else that you're doing to diligence that business and close on it. And I think that's really important that like, especially on the micro business side, like kind of like acquire, right? Like with .com, like it really matters how much money you're spending, as an incremental input. If I'm paying 2x ARR versus the total deal cost on a small acquisition might be 4x when you include legal and tax and everything else. So
Yeah, I completely agree. I see that all the time where legal fees run up to like 50, 60, 70K and it's like 100K or 200K a deal or something like that.
Crazy, yeah. Well, one of the tips I can actually give it, like, so if you go and call a bunch of lawyers, I figured this out early on when I was doing my first few acquisitions. You call a bunch of lawyers and ask, I'm doing an acquisition. They're immediately going to say, 100 to 150K, right? That's like a price point, right? But if you say, I'm doing a business transaction, which is true technically at a small scale, right? A lot of these like deals are basically like small like partnerships or businesses, like you can call them acquisitions, but on a small scale, they're really business transactions, and you just have the lawyer charge you hourly for that. The business transaction is going to cost you 25 or 450K. But because you say it's an acquisition, like the framing of it now is instantly a higher benchmark, even though the hours are the same. So it's a little bit odd, but that's a bit of a hack. I'd say that seems to have worked better in my experience when I was doing like very, very small acquisitions a few years ago. So that's the tip. Get them to help you with the business transaction, and then a partnership, so to speak. And then
That's clever. That reminds me of where some venues will charge you a lot if you say it's a wedding, and if you say it's a family event, it's like a fourth of the price or something like that.
Yeah, I've never heard that, but that sounds exactly right. Right, it's just all the framing. Like people are willing to spend more because of the milestone or significance of said event. So
Yeah. What are your favorite growth levers when you look to buy a business? You mentioned distribution a lot. Do you look at pricing? Do you look at synergies across customer bases?
yeah, definitely synergies. I think the biggest one though, especially at like our scale now, as we start to get much, much larger, the biggest thing is like team and like the alignment there. So like, like we want to make sure we're aligned with the team. So we also look at it from the perspective of like an acqui-hire, like, are we getting good talent with them too? Right. And are they aligned culturally? And then I think beyond that, we're looking for, things that could plug into an end-to-end platform. So like things you can build off of and build around. We'd be much less interested in like standalone products that are completely disparate from what we're working on. So that's probably the big thing. My best advice to like any founders or people looking to get their business acquired would be the businesses are bought, not sold. So like if you're trying to spend a lot of time to sell your business, what I would say, you can definitely run a full process, and that's helpful, and use a platform like Acquire. But I would say that like the best thing you can do is start to build those relationships and partnerships with like potential acquirers years in advance. Like a lot of the acquisitions we've done have been with companies we've known for some period of time, other than like Bench. But we've at least known people that work there, or people that, we are familiar with the products and services with those companies. So that makes a big, big difference, right? It makes it much easier. The trust is there and everything else. I think that goes a long way with sponsors internally at larger orgs, especially on corp dev side.
Completely agree. I think a lot of entrepreneurs underestimate just how long a strategic acquisition can take and how important that relationship is when the time comes to sell their business. So completely agree there. Let me ask you this. If you had, let's say, $1 million and you were starting over entirely, you didn't have any businesses, you could go acquire businesses, you could start something new and an interesting space. What do you think you do? You have to rewrite everything that you've done.
I'll give you a better answer to your question. I'll reframe the question as, I had $0. How would I go scale to like a lifestyle business of like 1 to 2 million ARR? And I can do it with zero. So that's really cool. I've been telling people this for like, I've been trying to shout this from the rooftops on like Twitter and stuff, but, and I got way too many DMs, but there's lots of businesses right now that like took venture capital, founder got burned out, left, and they're stuck at like 100 to 500K. And those businesses go to zero. They literally, I've had a deal, like 2 or 3 years ago where I won't mention any names of anybody, but like I offered 75K on a business that like ended up going to zero. But you can do different things. Once you have like a base platform, let's say you build something yourself and you spin up some like no code solution. It costs you basically nothing. Let's call it a couple $100, right? Now you can say, hey, my goal is to add on these other platforms. We're going to have like a micro role, like a tiny co, like Andrew Wilkinson's company, right? Where we're just going to plug in all these great, but we're going to do it for Microsoft or like Greg Eisenberg, right? That's done something similar, I think, with some different products on a smaller scale than Andrew, obviously. But I think like in that same vein, like you can uh, go and do all equity deals or earn out plus equity. Say, hey, Andrew, your business does up 200K a day. I'll give you 100K a year for the next 2 years, and then I'll give you $1 million in equity or whatever the price is. And you can basically do that, saying, hey, the total enterprise value will be 10 or 5 or whatever it is, your small business plus this. And you basically negotiate deals like that left and right. They're all over my inbox. Like, so if I was starting at zero, let's say I went bankrupt and I was starting over tomorrow, I would just go do the same thing. Hey, I'm going to take sweat equity. So I'm going to take, let's say $2 million. Your business is worth $2 million. I'll earn out my equity over this amount of time. I'll give you cash for your business on an earn out basis, plus equity in this new entity that I'm going to go build the next, Mainstreet and build a, $1 billion plus business. Right. So I think that would be my playbook for founders. Like I think you can do a bunch of micro roll ups where you can pay out small amounts of cash and build equity. And I think that's there all day, every day. I could roll up, a couple 100,000, in a month, basically. I think at least 2 or 3 deals of like that scale. So I think that is there. And then with efficiencies on like AI and automation and offshoring, you could basically run those businesses like very profitably and scalably, like with a very small lean team and have a very nice lifestyle business. The true like 4-hour work week. Like you want the true 4-hour work week, that would be it, other than spending a lot of time in M&A for a couple of months.
Yeah, I love that. I see it all the time at Acquire with people rolling out really, really interesting SaaS businesses. And some of them build, some mini empires that are doing, millions in profit per year. And they don't spend too much to get there. It's cool to watch. I completely agree with you.
Yeah, it's kind of an inflection point for myself, like too, like we either go and like swing to like go do something really big, which is generally where I'm at, ambitious one, like from an ambition perspective, but like, we're in the high 8 figures in ARR and growing pretty quickly. Like, but I have complete board control and own, over 50% of the business. So like the point being is I don't have to, you could run it as a lifestyle business if you wanted to and make, quite a lot of money and have a really great impact for your customers too. There's no scale issues.
Love it. All right. Final question. 5 years from now, where would you love to be? What's your ambition? What's your goal? What does that look like?
5 years is probably eternity. It seems like with how busy things have been, it'd be tough to say. I think like when I look out like a year from now, I think we can hit mid nine figures ARR and like a very clear path to getting there ourselves and continue to grow to basically become the next accounting leader in the software space over the next year, 2 years, 3 years, and definitely over 5. So that's where I'd see myself in that perspective. Boring. I'd say last thing in boring software is the best software. So anything like you have to have like, so first thing you do when you start a business, like accounting, payroll, tax, like banking, anything like that every business has to have or incorporation services, like those things are very, very interesting, even though they're not like sexy to the mass appeals. It's a great business down. So.
Right on. Well, Jesse, you're building a massive business. It's been exciting hearing about it. Excited to watch you continue to grow. And for those that want to follow you online, where can they find you?
You can find me on Twitter, LinkedIn, and just at Jesse Tinsley, first last name. And I would love to connect.
Right on. All right, Jesse. Thanks for coming on the podcast.
Yeah, likewise. Thanks.